Hey, everybody. Welcome back to Markets in Turmoil.
I wish we had a production budget where we could add echo to that.
That'd be great, wouldn't it? That'd be great. Yeah, I feel we're a little bit CNBC right now. This is indeed Investing Unscripted. I'm Jason Hall, joined by Jeff Santoro. But the markets are in turmoil. We are taping this the afternoon of April 8th. And holy cow. So going back to last week, Wednesday, after the market closed, President Trump announced, what was it called? What did he call it?
Liberation Day, but I refuse to say it without doing air quotes.
You have to air quotes, right? And I will say probably my favorite quip since then was, I believe it was Eric, our listener Eric, on the first Friday live stream that we did this past Friday, said that his portfolio has certainly been, that he has certainly been liberated of his backside. So, and then of course, so we saw those bad couple days last week. And then this week, Monday, and again, it's Tuesday as we're taping this on the 8th, just the market is whipsawing, absolutely whipsawing up and down based on any information the market sees about what may happen with the tariffs.
Yeah. And we're recording this on the 8th. It's going to drop on the 9th. We usually don't turn our episodes around that quickly, but we changed our production schedule a little bit to put out something that we hope is timely and helpful for listeners. So this will not have aged too badly by the time
it could be completely aged. Let's be honest.
All right. Relative to how fast news moves right now, it will not be that old for our listeners when it drops on the 9th.
Well, and directionally, I hope the conversation is useful. That's the reason we're doing this quickly. We're not trying to come to the market fast, but thinking about what we're feeling, what we're doing, talking through our process, and what we intend to do going forward. Hopefully it'll be timely from the perspective of a useful conversation to share with all of our listeners. So we hope you enjoy it. Hope you share it with other people too. Really hope you review our podcast and maybe give us some 5-star reviews too.
Yeah, that'd be great.
Yeah. All right, Jeff. So again, as we're taping this, it's been another whipsaw day, back-to-back days. I'm not even going to say if the market was up or down, because by the time people are listening to it, it won't really matter whether the market was up or down by the time we finish this. But the backstory, of course, is tariffs on essentially everything that's imported into the United States, even territories that are islands entirely populated by penguins and seals.
Yeah. Well, I'm glad the penguins are finally getting what they had coming to them for so long.
Fair.
When they started flying planes in the Madagascar movies,
yeah,
that's when I knew.
Well, if you're at that level, then you're advanced enough to have a tax base. So
seriously, don't tell me you have no economy if you can fly an airplane. Penguins, ridiculous.
Even though you're cartoon penguins, doesn't matter. All right, that's enough silliness. But I mean, I think we have to be silly to a certain extent because of just the.
If you can't laugh, you'll cry.
Yeah, no, that's exactly right. So the market is down. The S&P 500 is down about 10%, 11% roughly. The NASDAQ 100 is down about the same. The Dow's down roughly 10% since the tariffs were announced. And we've seen a lot of back and forth. China has implemented some retaliatory tariffs. The EU has put in some targeted retaliatory tariffs as well. So we're starting to see the tit for tat begin to happen with the response. And at this point, there's zero negotiation. There's zero traction anywhere towards an actual resolution. And that's reflected in the markets whipsawing back and forth, Jeff. And we've certainly seen a lot of increased risk of recession as a result of this. The probability of recession is very high. There's the chance that we will have not even done the soft landing. Remember, we were all talking about that, but it was the no landing, right? The plane just kept flying, only to intentionally crash it into the ground, it feels like here. And I know, let me say this too. I want to be fair because politics has become more pervasive in society, and a lot of us view things through the lens of our politics to some degree. And I know there's a lot of people that continue to support these actions. And I understand a lot of the reasons behind it. Jeff, you and I have talked offline about the challenges we've seen from government writ large. Pick whatever party you want to actually effectively govern and implement a government that works for the people. And there's a lot of people frustration across the political spectrum. So I certainly understand the idea behind looking for disruption, because sometimes you do have to break things down to rebuild them in a way that works. So I get that. I don't want to sound dismissive to anybody that might be supporting of these policies. But with that said, if things remain the way they are, it is going to be extremely damaging to the economy. It's going to be extremely damaging to people's ability to spend and extremely damaging to people's personal wealth.
Yeah. And I want to just build upon what you said. Like, I understand people supporting the purported goals of these policies. My concern is that I'm not sure these policies achieve said goals.
Right.
That's where I'm
Yeah.
seeing a disconnect.
Yep.
And that's not me making my own judgment. I'm not an economist. That's me listening to literally every economist I hear talk about this. So yeah, that's how I'm coming at it. It's just, the idea that someone saying that they don't think we should have as many trade deficits with as many countries, fine. Like, okay, that's a debate. You can debate that. I just don't know how this necessarily fixes that. I could see the argument for wanting to have more manufacturing in the United States. I actually agree with that in
100%.
some places. But then there's the reality too. So if we're going to start making sneakers and t-shirts and assembling iPhones here, find me the tens of thousands of Americans who are going to be willing to do those jobs.
Right.
Right.
And now find me the American consumers that are going to be willing to pay
twice as
even
much for an
more
iPhone.
than the price that the tariffs is going to. So the tariffs are an artificial inflation of prices if we move manufacturing to the US for a lot of those labor intensive things. And that's another thing. Like, there's this idea that like making iPhones is automated. It's extremely labor intensive, right? So the cost to do those things could double. But again, we know all that. So we're at the risk already of falling into too much of the political discourse. But it's part of the story, right? Because this is a thing that's going to certainly color people's views and decisions that they make. But I wrote about it in Random Words last week that this is exactly, and like, here's where I'm coming from. And I want to talk about kind of where you are right now. I don't care why the market is falling. I mean, I do, right? Because there's implications and we need to understand those implications to think about like our real world lives and also think about how we're going to deploy capital to try to make smart decisions based on short-term, long-term goals and managing the risks through those periods too. But at the end of the day, we're in the middle of a market sell-off, right? Right now, we're just in the correction phase. We haven't seen like a full 20, 30 crash, right? We haven't seen a full crash, right? It's just, so far, it's a low speed fender bender, right? At this point. But if the economy crashes, the market's going to crash hard. But this is what we invest for. These are the kind of moments that we're supposed to have spent our time preparing ourselves to act in our own best interest. And I know for a lot of people, it's harder right now to do that because so much of this is colored by where you're viewing this from a political perspective. So where are you right now? Where's your head?
The thing I'm struggling with, and this is the extent to which I do think about the politics of this, is that unlike the COVID crash, unlike the great financial crisis, unlike the tech bubble, unlike the aftermath of 9/11, like pick your market shocking event, this is one that's a policy choice. And again, you can debate the validity and positives and negatives of said choice, but it is a policy choice. And that's what makes it bizarre. So I'll use the pandemic as an analogy here because it's the most recent one I think most people listening can remember. The whole thing with that was, oh crap, the economy's basically shut down. We can't go out. Businesses are closed. But I think everyone knew in the back of their mind, like, okay, but at some point this will end.
Yeah.
Now, I don't know that we knew it would end as quickly as it did, right? We were lucky to have vaccines as quickly as we did. And then kind of after that, within months, we were starting to reopen things and things got back on track. And
well, and we're also lucky that this became an endemic virus, that it evolved as quickly as it did from this highly lethal virus when it was first evolved to infect humans to now that for most people, it's like the flu.
Right, exactly. But my point is that the only question then was how long would it take?
Yeah. Yeah.
Right. Would it be 6 months? Would it be 2 years? And the difference here is like, and no one knew the answer to that question with the pandemic. And I think no one knows the answer now. But what's weird about now is there is a scenario in which over the course of the next couple days and weeks, whether they are legitimate concessions or ones used to save face, there is a world in which the administration says, hey, you know what? This country, they came to the bargaining table, tariffs are gone. You know what? This country, they came to the bargaining table, tariffs are gone. And you could paint a scenario where this is all done in 6 months. Mm-hmm. You could also paint the opposite scenario.
Yeah,
and
no, that's right.
I think that's what's different about this in my mind And
Right.
it actually gives me a little bit more hesitation because it's even more unknown, right? Like I remember during the pandemic, I was a very new investor. And one of the things I did was I bought a couple airline stocks because I was I mean, this is before I really understood like how to research stocks and stuff. I was just like,
So it's really
well,
not that different than you now.
fair. No, but my thinking was very basic. Like, yeah, okay, no one's traveling right now, but these stocks are just been destroyed. So like they're
Yeah.
cheap. I'll buy them now. And then when the world reopens, I'll have stocks that were cheap that will now do great. Now, what I didn't realize is that airline stocks are generally crappy investments. But
Right. And the
that was
fact
my
that they had
thinking
to
at the
borrow
time.
billions and billions of dollars to keep the doors open.
Right.
While
I didn't
nobody
know
was
any of
buying.
that.
Yeah. Yeah. Right.
But that was basically where my head was in all my investing back then. Like, oh, this
Yeah.
is beat down because of this event. This event will pass. It will be better then. I'll buy it now. And I think it's a little bit harder to do that now because that was a binary thing. World is shut down, can't fly, go on vacation. World will reopen, can fly, can go on vacation.
If
And
it
now
doesn't reopen, the fact that you bought those airline stocks probably won't really matter.
yeah, bigger
Yeah.
problems.
Yeah.
And there's just 11 different ways this could go. And I think that's what's challenging about it. So I have more thoughts, but that's kind of where, like on a basic level, where my head's been over the past week.
Yeah. And I've gone through a little bit of that too. And I want to say this too, because I know there's people listening that are saying the pandemic was a policy choice too. And there's lots of cases where that was true, but the pandemic wasn't started because of a policy choice in the same way that you go back to the global financial crisis. There were lots of policy decisions that were made along the way that affected the outcome, right? There was this battle in real time in the US between austerity and continuing to increase debt to fund the government and fund government programs. And we saw in Europe, the countries that chose austerity almost went insolvent, right? And had to change. So we saw all of those things happening with the back and forth. So the reason I bring that up is that while it seems like it's amplified right now and heightened right now, and there's certainly like a key man risk right here with President Donald Trump, this is his show, right? This is the thing that, he's running the policy, whatever your stance on whether it's constitutional or not. The bottom line is that if Congress controls the purse, Congress and the president are aligned in the same party, they're choosing to let the president run with this. That's a tacit endorsement that this is the action that they support. So it is the reality. And any time there's a crisis, a massive crisis like this, there are going to be policy decisions made along the way that have implications. So it's heightened right now. But what I've really, really tried to do is be laser focused on what are my frameworks? What are my goals? What are the things that I've done over the past year, 5 years, 10 years to build to the level of success that I'm at now, the things that have worked, that I've optimized for? And what is the risk of changing anything at this point, right? Versus the upside. And trying to be laser focused on that so I can act in my own best interest. And I will say this, I probably have bought more slowly. Not probably, I've absolutely bought more slowly than I ever have in any prior fast market sell-off like this. Jeff, I'm pretty sure it's hard to not be both myopic and also blinded to your own changes and biases. But I think it's largely because that's directionally where I was already going as an investor, right? So I think that that's kind of the reality for me.
Yeah, here's another reality, right? Unless you are currently in your early 20s or you're still decades away from retirement, like you and I are roughly the same age, although you're definitely older than me. We're both 5 years closer to retirement than we were during the pandemic. And anyone who's been listening to the podcast over the past year knows that you've done a lot of work to slowly transition from wealth growth mode to wealth preservation mode, right?
Right. Just asset allocation.
Yeah.
Yeah.
So that does make sense to slow down a little bit. For me, I'm really not doing anything differently than I would have if this hadn't happened. And that's my strategy. Like and I've said this before, like during 2022, which was not the quick drop like we saw in the pandemic, but that was the last time that we had the prolonged downturn where I actually at least kind of knew what I was doing. There were too many days over the course of that 18-month slog through a bear market where I was like, today I'm going to deploy 6 times as much cash as I normally would because we got to be near the bottom, right? And in hindsight, I wish I just spread that out a little bit more because it lasted longer than I thought it would. And Looking back, I was probably trying to time the market a little bit. And if I'm making a mistake now, it's that I'm being too inactive. I'm being too regimented with my normal process. Like I was telling you before we started recording, I typically buy once or twice a month because the money hits my account in the beginning and about halfway through each month. So like once it's there and I have the time, I look around and decide what to buy. And I did that for like a week ago. I bought a little bit of a stock I already owned because that was what I used that first little tranche of money that hit my account for. And I'm not doing anything till the next little bit hits in a couple days or weeks. And I'm just going to buy when I buy. Like I'm not.
Yeah.
And look, I might look back. If the market rallies from today, I'll look back and be like, well, that was a missed opportunity, right? Because now everything is not as cheap as it was. But that's me trying to not time the market. And I think the other piece of relevant information in terms of the way I'm thinking about this is I have invested through a little bit of the dot-com bust, the great financial crisis, the pandemic, 2022, in the sense that every 2 weeks I've been contributing to my retirement accounts. And I didn't do anything differently then, right? I didn't increase my contributions or decrease my contributions. I didn't even think about it. I just went to work and every 2 weeks I got a paycheck and part of it went to my retirement accounts. And I'm in a comfortable place in terms of my retirement savings right now today because I invested through all that. I'm sure some not insignificant percent of the gains I have today are because I was investing in April of 2020 and all throughout 2022 and in 2008 and 2009. So that's kind of the other thing that I'm thinking about in terms of not rushing into anything.
So as we've talked about a lot, I have increased my cash holdings. And frankly, the biggest reason I increased my cash holdings is as we've seen the market continue to do so extremely well, I've wanted to have more cash to be opportunistic in these sorts of environments. And one of the things I've learned is about these sorts of environments is it's very easy to get mired in the why and falling into false precision of waiting for the bottom and it's going to get worse. I can get better. That sort of thing. And I don't want to be that ass that falls in love with cash that I raised specifically to act in these sorts of environments, right? So that's why one of the things that I'm pretty firm about is a little bit of rules-based expectation around sell-offs when we do see these broad market sell-offs. Because I do think this is the time where in the part of your portfolio where volatility is viewed as a risk by most people, but it's an opportunity, this cash exists to be opportunistic during that. I've already done a couple of things. The one thing that I did last week, again, using options, I've begun using options a lot more for trying to build out positions, but I used options on Shopify. Shopify stock has absolutely been pummeled, but it's like the e-commerce operating system for thousands and thousands of small, medium, and even enterprise-sized businesses where this is the tools that they use for commerce, keep an inventory, increasingly for things like marketing, just all the tools that they need to run their business to, the point of sale, building the website, integrating your physical retail with your e-commerce, if you do both, omni-channel tools, like all of the things. If you're a merchant, I mean, you would have to pick multiple products from a lot of different vendors to DIY build your own thing. That Shopify it's the whole thing. So it's incredibly sticky. As successful as the business has been, and it's been one of my better stocks that I've ever bought, it's not a huge portion of my portfolio. So I decided to build a synthetic long. I sold puts and these are all long dated, like they don't expire until next year, early next year, because I wanted to build in something for the noise that we're going through. But I was conservative with the prices such that if the worst case scenario here, because with a synthetic long, you're selling a put, so you're getting paid and somebody else just bought the option to make you buy stock. If Shopify's business erodes or the market completely comes undone, I might have to buy Shopify stock for substantially more than the market price at the time. So that's the risk. And I'm compounding it because I took the premium that I got paid, Jeff, to buy calls. But the idea is if you're really bullish on a business and you believe the fundamentals are going to hold up, you get to use that income from the put, which is going to expire worthless anyway, because nobody's going to sell you the stock at a lower price than the market's trading for. But you use that put to buy the option to buy that price if the stock is trading substantially higher. So I'm going to use $90 as the number. So if the stock's trading for $125, I'll get to buy it for 90 and the put premium paid for that option. So I've taken on some downside risk, but I've also created some optionality to be able to increase my Shopify position. At the same time, I've got a shopping list of stocks that I'm getting ready to buy in the next couple of days. Obviously, I don't want to mention them because of our disclosure agreement with our contractor that we both work for, the Motley Fool. But in the weeks ahead, I'll be talking more about some of the decisions that I've made to deploy probably a quarter to a third of the cash that I have, which is not a small amount of money. But at the same time, Jeff, we talked about this before we recorded. I've actually done something using options that is basically short the market. It's not a true short. I used options. I bought a put, but it risks a very small portion of my portfolio. It risks about 0.5% of my portfolio. In a kind of the worst case scenario for this specific thing, the money I spent in this put is if it expires worthless, I will have spent about 0.5% of my portfolio to buy it. But if it expires worthless, it's because the stock market went up, which means that everything else that I own will have gone up in value, right? So I think of it kind of as insurance. If we do see a protracted continued sell-off, the upside is probably for it turning into 1.5%, 2% of my portfolio at present value, because the value of that put will go up and I'll sell it and lock in some cash, and then I can take that cash and I can use it to redeploy during those market lows. So being opportunistic, but also trying to be cognizant of the fact that this could be protracted, and I want to position myself to continue to deploy capital across a protracted downturn.
Hey, everybody, we'll be right back, but first, a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on around 1,800 stocks. So for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes.
Investing Unscripted is brought to you by the Chit Chat Stocks podcast. My name is Ryan.
And my name is Brent.
And we're the hosts of the show.
On Chit Chat Stocks, we are constantly researching new stocks from high flyers to undiscovered small caps, diving deep into business models, debating competitive advantages, dissecting valuations, and we have a fun time while doing it.
Supercharge your investing research and start listening to the podcast today. You can follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts. Follow the show so you never miss an episode. That is the Chit Chat Stocks podcast.
And what's important about everything you just said is a couple things. One, you keep cash to be able to do things like this.
Yeah.
You've been deploying options strategies for a while now before any of this was on our radar. You understand all of the downside risks. You're not trying to get rich quick. This is not like a bet that the market's going to fall tomorrow, right?
Yeah.
So I think for you, that's an appropriate way to step into this uncertainty because it's just a continuation of a strategy that you've already been deploying. I'm trying to do something similar, and you were teasing me before we started recording because you don't think I'm a good investor and my decisions are terrible, but I want to explain them.
It's not that I don't think you're a good investor. It's that I think you're a bad investor.
Thank you for clarifying that.
I'm kidding.
No, but here,
but we're taking I think your point is we're taking different strategies that fit for what we're trying to accomplish and also within our frameworks of how we invest.
Right. But I want to explain it a little bit more. So and I'll do it really briefly and I hope clearly.
Two things that you're much more qualified to do than I am.
Yeah. After your 11-minute answer you just gave, it won't matter. No one will hear this. They've all left the podcast. So One of the things I do pretty much every month when I decide what to buy is I sort my portfolio in a way that brings to the top the stocks that have done the best that I also own the least amount of. All right. So it's a way for me to see what my winners are and to think about if I want to add to my winners because they represent a smaller portion of my portfolio. And because of that, it's just a way of sorting. It just helps me think through what decisions I want to make. And then I don't invest that way necessarily. Like I might do that process and buy something that's in the bottom third or in the middle somewhere, just based on the
But it's
conviction I have.
eye-opening, and it keeps you from anchoring to things that you might view as negative, but are actually often in your best interest.
It's a way to force me to think about buying my winners.
Yeah.
And
right.
not trying to chase stocks down, right? And so anyway, I sort it that way and I think about it that way, but I don't always invest that way in normal times. What I'm doing now is a little bit more forcing myself to invest that way because I feel like in uncertain times, I like having some sort of loose structure. And so I can talk about it now because enough time has passed, but the stock I did buy a little bit more of last week was Costco. And for a few reasons. One, it's the most recent stock that I bought. And I've said on this podcast and other places, I bought it knowing it was overpriced with the intention of buying more of it as it became less overpriced. And it is less overpriced than when I bought it. So I bought a little bit more. Now, for context, my initial buy back in February was about, 0.3 shares. And I bought the other 0.7. Like that's all I did to round it up to a full share. And part of the reason I did that is because based on like how it has done relative to the market and how little I owned and how I'm trying to build a position, it was one of those that sorted its way to the top. And I could have bought 2/3 of my portfolio and felt good about the decision in terms of the valuation that day versus where it was 2 weeks ago. But I fell back on my process when I had a little bit of like, I could pick anything. I don't know what to pick. Because if I went the way that you were talking about, I should go and looking at the stocks that were the most discounted or had fallen the most, or like the ones that had been the most overpriced that are now more value, then I feel like I'm starting to get away from fundamental analysis and a little bit more into price. Whereas I just kind of let my framework and my system do a little bit of the thinking for me. Now, I don't know if I'll do that again later this month when I decide to make my next purchase. It just felt like the right thing to do on that. I think I did this on Friday of last week. So like that second huge down day after quote unquote Liberation Day. And it was just a way to help me not feel like I was trying to get too cute. So anyway, that's kind of where my head is right now in terms of what I've been doing. I've kept doing the covered call, like the weekly covered call strategy that I've been doing for about half a year now when I can. Not doing anything else crazy with options because that's not what I do normally. So this is not the time to like, let me try a new strategy. I'm just trying to stick to my knitting in uncertain times.
That's a really good point about not trying something drastically different in this sort of environment. And we interviewed Ben Carlson from Ritholtz Wealth Management, and we pushed that episode back to next week so we could do this one kind of in the midst of all of this. And that was one of the things that he talked about is, if you have a process and you've built a process and it's delivered, making the mistake at uncertain times of making drastic changes is almost always going to be a decision that leads to regret. I think that's right. You also mentioned options too. And that's one thing that's changed a lot for me over the past year, using cover calls for options for income. And I will tell you every single covered call, and this is a difference in the strategy that you use versus the one that I use. And again, it's based around our overall portfolio strategies. My portfolio is having, been a solo contractor operating my own solo 401k versus the company 401k, or in your case, a 403b, where you're just investing in funds. I have a large portfolio of individual stocks. So it's a lot easier for me to have multiple blocks of lots.
100 shares.
100 shares, right? The 100 share lots, which is what options are traded in. So what I do is instead of having weeklies, it's more work. I've done it in the past, but it's just a little more work than I want to do to try to follow. I'll sell options 6 months or a year out, and I try to ladder them to a certain extent. But I'm in a situation now where every single covered call that I've sold that expires over the next year, they're all way profitable right now because the market is down,
Mhm.
right? But I don't have to do anything. I can just leave them alone and let them expire completely worthless, assuming the market stays down from when I sold those calls. So it's a good way to have generated income. Part of my cash is from the premiums that I've earned from those calls. I don't have to do anything. I can just leave them alone. And on the other side, one of the things that I've done that's part of my strategy to build out more positions is selling puts. We've talked about this before, Jeff. One of the challenges for the market for me over the past, really most of last year, with so many companies that I was interested in adding to my position, the valuations just didn't line up with what I wanted to pay. So I sold a lot of put contracts deep in the money. For example, I sold puts on stocks that at the time traded for $80 a share, sold $50 puts or $60 puts. So you're looking at, the market having to drop, or that stock having to drop 25 or 30% or more to get to a place where the stock would potentially get put to me. And the advantage for me is instead of buying those stocks back then and now they're all down so much, I've put myself in a position where some of them, the stocks might actually get put to me below the put price. For example, I'll use one as an example, Endava, a business that I like, I don't love, but I like. Consulting is big, tech consulting is important, but Endava's really struggled a lot over the past couple of years. But I sold puts, $30 puts. So what does that mean? That means somebody can make me pay $30 a share for the stock. The shares are about $17.50 right now. So that's significantly down. But I got paid $9.61 a share. So my break even is like $21 on that. So again, back when I did it, the stock was well above $30 a share. And there's other stocks I've done, it's a lot more. And even if these expire, the stocks move back above it, I will have earned the premium along the way and created an opportunity to buy some of these stocks at a much lower price than they were trading for when I entered into that contract. But I didn't overpay, right? That's the key. I didn't overpay. And in total, I've got maybe like 8% of my portfolio tied up here. So it's not like I have massive exposure, but there's at least 15 companies, most that I own, a couple that I don't, that I want to own, that it's given me the potential to have exposure to. Doing all of those things is part of the reason that I've been a little slower to move into cash. But I'm about to start getting a little bit aggressive with some of the cash that I have.
So speaking of that, let's look forward. We've done a lot of looking back, talking about what we have done and how we're thinking about this. Two-sided question for you. What are you most worried about as it pertains to the market? And what are you most potentially excited about as we look forward?
The biggest thing that I'm worried about is this becoming protracted, where it starts really hitting consumers and it starts causing businesses to pull back on some of their capital decisions and layoffs that start to follow along with this. I'm worried about that, right? Because my concern is that I'm going to run out of cash before I run out of opportunities. So just being like that kind of cynical, pragmatic, like the worst part of being an investor out there, I want to fully leverage the opportunity, and people are going to get hurt along the way. And that's my biggest concern, is that this does get to the point where the economic harm happens and the tools at the hands of the government to address what will be a government caused thing will be limited in terms of their ability to correct that. So that's what I'm worried about. I really think that I've allocated it incredibly well to minimize the harm to my family's wealth in this situation. I'm worried about, what it's going to do to a lot of people.
Yeah, I don't want to see widespread economic impact where we start seeing high unemployment and a long recession, forgetting the investing opportunity that comes along with that. I just don't want to see that as a human being.
Right.
You got me thinking about something where this is one of the things that I'm worried about in terms of my own investing, right? So I'm thinking of this situation in sort of first and second and third order impact, right? So the first order impacts I think are pretty obvious, right? Like the domestic automakers are going to have a tough time if we're putting tariffs on Canada and Mexico, right? And you're going to see goods get more expensive, like sneakers and shirts and iPhones, if we have tariffs on Vietnam and China, right? So those are like the first order impacts. Then there's the second order impacts, which are what retaliatory tariffs or other policies that other countries do impact industries we're not thinking about yet. And then there's like the third level to this, which is a company that you might buy right now thinking to yourself, oh man, this is a domestic company. It has nothing to do with imports. Like they're completely insulated. And an example I thought of recently was a company like Toast. So Toast is a company that very simply operates the front and back end technology for like restaurants, right? So like they have little terminals that you pay your credit card on when you check out, but they also can handle back office stuff like inventory and payroll and scheduling and things like that. So you think to yourself, all right, so yeah, if there's like a big economic downturn and people eat out less, maybe they get, because some of their money comes from transaction volume. But I think the bigger impact for something like a company like that is they're growing their customer base pretty robustly right now. And part of that is companies switching over, right? So like maybe it's a restaurant that used to use Square and they want to switch over to Toast. But part of it is also maybe they're in with a big chain. Like I'm just going to say Olive Garden because it's just the first thing that came to my head. I don't know if they're a customer. I'm just going to use them as an example. Let's say Olive Garden. And Olive Garden has a plan to expand their store count over the next 5 years, right? So Toast is probably thinking, great, that's built-in revenue for us, right? They're already a customer. Every time they open a new store, we're going to put our stuff in. That's great. What happens when these restaurant groups look at just the landscape right now, forget specifically tariffs, just the uncertainty, and they say to themselves, you know what, change our mind. This is not the time to be expanding. We're going to pull back drastically. We're only going to grow our store count 1% a year, or we're going to stop growing our store count, whatever it is. Just one silly example. But when I think about like what I'm worried about in terms of my investing is like, this is part of the reason I'm being so slow and methodical and sticking to my frameworks is I don't want to make the bad decision of piling into a stock I think is insulated. And then in 6 months, I find out, oh, wait, they're really not because of this second or third order effect I wasn't even considering. And I think that's what's scary about this. Like you said, you used the word protracted. I'm on the same page with you. There are going to be impacts to this, the worse it gets over time, that I think most people aren't going to consider. So yeah. I'm just trying to like spread my bets around, like just maybe add a little bit to all the companies I like as they get a little cheaper here, and not try to make, I don't need to be a hero here and try to make the one trade that I'm going to brag about for the next 20 years. Cause I don't think we're all aware of how the ripple effects of this over the next months and years.
Yeah, no, that's right. I think that's right. And I think the important thing I want to say, Jeff, is neither one of us said our biggest concern was the market continuing to go down from here and that effect on us. I think we both have done a pretty good job of treating our real world needs separately from our portfolios and allocating asset-wise appropriately so that we are relatively positioned that this is neutral in the real world, but opportunistic for our long-term goals. And I encourage anybody listening to make sure, if you're in a situation right now where you're worried about your income next year, if the market crashes, you have an allocation problem, right? So just want to remind people about that. You asked me a two-part question though.
Yeah, we both didn't really answer the second part yet. What are you, I don't know what word to use. Like, what are you excited about? What are you hopeful for? Like, maybe a way to ask it is what's the best case scenario here?
Here's the question that I want to answer. Where am I thinking or seeing opportunity?
Yeah, maybe that's the way to think of it.
And this is an area where you and I are taking different approaches. And I appreciate the way that you're doing it because it keeps you focused and keeps your feet moving, right? That's one of the things that if you ever watch football and the announcers are talking about a running back and they're praising the running back, a lot of times what they're going to say is he's really good at keeping his feet moving, right? Because as soon as those legs stop, he's going down, right? So as an investor, you're keeping your feet moving, right? You're continuing to stay active as a buyer and deployer of capital. And I'm taking a little bit of a different approach, but generally I'm doing kind of the same thing. I'm trying to act opportunistic in the way that I've always done it in my raccoon on meth way, where I'll go through these periods of inactivity and then I get some of the good stuff and go crazy and deploy a lot of capital.
And I know it's coming. I know there's a day in the next, I'll say 2 or 3 weeks where you're just going to text me either screenshots of the stocks you bought or the dollar amount that you've just deployed, and I will be like, here he is,
Yeah.
Jason Hall, the raccoon on
And the
back.
difference in the approach that you and I are taking right now, and I know the past couple of years, it might sound like I'm a buy the dip guy, because a lot of times when we're talking about it, it's when the market's down or there's volatility. And because I have started to change my my framework based around getting closer to those financial goals that we've talked about. But generally, I prefer to average up. You know, if everything's going fine and the market's doing its thing, and maybe we've gone through a sell-off last year and market's mostly going up now, but hey, here's this great company that I bought 5 years ago, and it's time to buy more. I want to own more of this company. I might pay a little bit lower valuation, but the stock price has gone up. I love those. That's like the optimal way to do it for me. And Jeff, it's also like a reminder of how this is not zero sum. This is not a zero sum thing. I always like to think about buying, like I bought some Mercado Libre last year at some point. And like in my head, like I was imagining that there's this family that bought Mercado Libre 10 years ago, and now they've had a kid and they were surprised, and it's a joyous moment. And they realize, well, we need a bigger house. How are we going to pay for it? Well, Mercado Libre has done really well for us, so we can sell some of that Mercado Libre to help make the down payment on that bigger house. And like, I'm imagining in the back of my head, this is who I'm buying it from. So this is not a zero sum thing where there's a loser on the other end and I'm trying to win the trade.
Right.
These people benefited from the wealth that this business has created. And now they're just passing the baton to me, and I'm giving them some money, and it can continue to create value for me. So like, I try to see through like the zero sum aspect of it, and remember that compounding of value, and then we cash out when we need those proceeds in the real world. Generally, I like to operate that way. But in these sorts of situations, bro, it gets a little bit zero sum where, you know, the panic sets in and people are selling perfectly wonderful businesses for reasons around their fear and uncertainty, right? And greed is part of it too, because you're trying to keep what you have and you can't see past this moment to a brighter future, right? So I'm very happy to buy stocks that have fallen a lot more than the market, because generally, if these are really high quality businesses that have fallen more than the market, and the prior history of that stock is it's probably gone up a lot more than the market. The volatility works both ways, right? So that's what I'm looking at right now. Again, Shopify last week is an example of exactly that.
I'm glad you mentioned Shopify again, because I actually wanted to jump in on this before when you were talking about it. That's one where I would have probably bought that one on Friday instead of Costco if I hadn't just bought it like 2 weeks ago.
Terrible excuse. You should have bought it anyway.
I did think about it, but all right. But here's the thing, because this is exactly the second point I wanted to make just now, which is it's down a lot.
Yeah.
If it, let's say there's a day, let's say today it closes up 10%. Guess what? Still down. Let's say it closes today up 20%. Guess what? Still down from before.
You don't have to buy them all at once.
When you see a quick 10% over like 2 days, and a stock like Shopify falls probably closer to 20%. I didn't look specifically, but it got hit pretty hard. 20% doesn't make it up, right? It has to do more than 20% to get back to where it was. So if I'm slow purposefully, and let's say I buy Shopify on April 29th.
Shopify stock is down 20%.
Right. So I could buy that in April or May or June, and there's a chance it's still down from before Liberation Day. Sorry. "Quote unquote" Liberation Day.
There you go. It's down 22% since Liberation Day.
Right.
So far this year.
And that's kind of where what I'm thinking with a lot of these, right? When
it's down 40% from the high this year.
Yeah, it's probably not coming back to where it was quickly. Could it? Yes. Is it likely? Probably not.
But you have time.
Exactly.
Yeah. Agreed.
And that's why I don't feel like I need to rush into anything and just sort of chip away at the companies that are now cheaper than they were.
All right. So this all happened really quick. So I'm curious, of everything that's happening and has happened so far, what's kind of stands out to you the most?
I already said the one thing, which is this feels so much more uncertain, yet also bizarre in the sense that it could go in either direction, basically on any given day, depending on the whims of our president. And I think that is what has mostly stuck out to me. Like, again, with the pandemic, it was like, we have to get a vaccine. We have to get to the point where people aren't dying from this. Who knows how long that will take? But there was a clear, like, we have to get to that point for this to all be behind us. And it could be twice as bad in a week. It could be twice as good in a week. Who knows? That's the first thing. And the second thing is, and I think this has always been the case when there's a big sell-off. I think this will always be the case when there is a big sell-off. And it's something you just alluded to a few minutes ago. There will always be people who panic sell and who just, they see 1 or 2 red days and they're like, that's it. It's over. I'm out. I'm going to cash. And sometimes we take advantage of that, right? That zero-sum comment that you made. And I think that's the aspect of this that keeps me very comfortably investing, is that I know for a fact that some amount of the percentages down my stocks is due to just nothing, some of it is legitimate concern about that company's business or the overall economic outlook, but some amount of it is just panic. It's just, either someone has had big gains and they have a little couple red days and they say, you know what, I'm ahead of the game. Let me just get out now and not worry about it, or, whatever the reason is. And I think that's something just that helps me invest through tough times and not really that's not the part I ever worry about. I'm always comfortable to buy in a downturn. I might question if I'm buying the right thing in a downturn, but the idea of buying in a downturn has never been.
You shouldn't question that, because just ask me and I'll tell you, no, you're not buying the right thing.
Yeah, no, I know. I can always turn to you for that. I mean, honestly, mostly what I do is I ask you what you're interested in and then not do that.
Just not do it. Yeah.
That helps.
That's smart. The thing that's surprised me the most, and in hindsight, it shouldn't, but the past 2 days have been just whipsaw ups and downs. To see them, generally what you see with the market is that whatever the trend that starts in the morning, that's the trend that holds throughout the trading day, right? Until the end of the day, it might change a little bit. Now, the exception is when there's big macro stuff that's anticipated, right? Then you see the market is a little quieter before that happens. And then whenever that announcement comes out, jobs report or the Fed's, their meetings about interest rates, like that kind of stuff, that kind of stuff will move the market in the middle of the day. So yesterday on the 7th, the market swung from big losses to big gains. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 separate times. The market moved from being positive to down. And some of those movements were like up 3%, down 2%, right? Yeah. Massive swings. Today wasn't as volatile, and the trend has mostly been down, but would try to recover and then give up a little bit and try to recover again and then give up a little bit. And it's the markets, again, the market started up 4%. I think early mid-morning trading was up. NASDAQ 100 was up like 4.2%, and now it's down.
Yeah.
So that has really kind of stood out to me.
The other thing that sticks out to me anytime we have stuff like this happen is it's interesting to me how much a green day or 2 break-even-ish days, like it looks like today will end somewhere around.
That's a good band name.
What?
Green Day.
Yeah. Someone should use that.
It should. Yeah. It'll never happen.
But let's say today ends relatively flattish. So that'll be 2 days in a row where basically flat. It's amazing how much that puts a pause on the panic.
Yeah.
Right. Like Thursday, Friday, and over the weekend, the market falling was like the top story on every news site. And then it stopped after yesterday for a lot of places. And
I think National Geographic ran it as their main story. I'm kidding. They didn't, but it was everywhere.
So I've always found that interesting. It's basically still as bad as it was 2 days ago, but everyone feels a lot better because it just stayed flat for a little while. But it just goes to show you how interesting the next, I think, couple of weeks will be as we see how this either does or does not change with concessions or not.
All right, we got a couple more questions here as we approach the end of our time together right now. Thinking about your strategy, your long-term strategy and frameworks and tools that you use, are there things that have worked that now heading into this period of kind of difference with volatility and uncertainty that you think are going to be useful tools to have?
I mean, I think I haven't done much different, but one thing I did over the past couple years really is due to some inheritance and a decision I made to sell some stock that my wife had accumulated from her company and then put all that cash into CDs in preparation to pay for college in a couple years. My son's a junior, so about a little over a year from now, we'll be making a decision on where he's going, and probably shortly after that have to pay some sort of beginnings of tuition. Obviously not predicting tariffs or anything like that. I just basic financial knowledge and personal finance of any money you want to use or need to use in the next couple of years don't have in the market. I've had a lot of more cash out of the market than I'm like comfortable with than I usually do, because I want to use it to pay for college. And that's easy to tell yourself, oh, this is the right thing to do. But then there's always a little bit of regret when the market's like booming and you're like, oh, if I had taken that money and put it in this stock, I'd have a lot more money. But right now I feel pretty,
this is the corollary, right?
Right now I feel pretty good about it. Because,
exactly.
And it's not that, like selling stock to pay for college was never really in my like playbook. I would have probably just invested that money regularly and then just paid for college sort of out of like my cash flows, or maybe take out a little more debt or put some student debt on my kid's name, once I use the 529 money. I don't think that's going to cover all of it. But because I had these opportunities to just build a little more cash, I decided to like specifically allocate it for that reason. And yeah, this is why you do it, because had I decided to, if I did decide, you know what, I'll just sell some stock and pay for college. Like, who knows? Like a year from now, the market could be down from where it is now, and I could be selling assets at depressed prices because I have to.
Yeah.
And so, yeah, I've not really changed much about what I'm doing right now, but there's some preparation I've done over the past couple of years, and you too, which I'm sure you'll talk about, that it's nice. It's like a reassuring thing to know that the decision I made a couple of years ago, specifically in case there was a moment like this, is looking like the right thing to have done.
It's just a spin on Buffett's quote about diversification as a hedge against ignorance. It's often used as a way to say diversify your stock portfolio. But I mean, when it comes to asset allocation, diversification should happen because of ignorance. And it's exactly because we don't know what the future is going to bring. And at some point you have to think about downside risk in the near term versus potential upside that you might miss. And missing that upside doesn't matter. It's making sure you don't lose money. So it's the right decisions to make. And I was really giving you some like major eye rolls so bad your eyes were about to pop out of your head. I was texting you recently when I pointed out that the move I made last spring to start increasing my cash position, and then this past fall to start investing in more bonds through the bond ETFs. I mean, if you look at the timing, I'm clearly the best investor in the world, Jeff. Yeah, I got lucky as hell, like with that timing. I'm not going to, even kid about that. I mean, I am the best investor in the world, but I also got lucky. But it's, it matters, and it pays off because of times like this, where I am in a position where a sell-off is an opportunity and it's not a risk, right? And I get to kind of leverage that, even to the point of changing my strategy again, where if we do go through a protracted sell-off, that, call it 5% of the portfolio that's in bond ETFs, in addition to the cash that I have, in addition to the continued contributions that we'll be making, is more opportunity to invest in stocks during a protracted downturn, right? More ways to potentially emerge from this stronger, right? We think about the strongest businesses that we own. Often they go through these sorts of environments and they emerge stronger than their competitors. They've taken market share, they've consolidated, they've built on their lead, right? So I've tried to build a portfolio and a framework that allows me to be able to do the same thing while also succeeding across a bull market as well.
And just as we end here, to give you credit, I don't know if it's specifically on the episode that we did about your decision to go into bonds, but during that time when you were making that transition, you said exactly this, which was I'm doing this for these reasons, but the other like happy accident or secondary effect of this that could happen is if we do see like a huge pullback, I can always pivot back and buy some stocks with this money, right? So like you were seeing that optionality being there, even back when you first made the decision. And I don't like giving you compliments, so I'd like to ask you to end the episode now.
I like it when you give me compliments, Jeff. And I'm going to take this clip and I'm going to make it short, and I'm going to put it on all of our socials, and I'm going to pin it to all of our, I'm kidding, I won't. Friends, thanks for hanging out with us while we have this conversation. We're going to keep talking about it as we go through things. We'll probably spit out a couple of Stocks Unscripted episodes at some point too. If there's anything you want to hear us talk about, please share it with us. And Jeff, how do people share things with us like that?
Any way that they want to. You can email us. You can hit us up on social media. You can leave a comment on Spotify. Spotify allows you to do that. But if you want us to actually read it, the first thing you have to do is give us a 5-star rating and write a nice review on Apple Podcasts and Spotify. Then we'll be able to see your feedback.
Yeah, exactly. Okay. All right, Jeff, that's it for us, right?
That's it.
Okay, everybody, just remember, we love giving our answers to these hard investing questions. And guys, this is a hard time. I know it's harder for a lot of people to make decisions in their own best interest going forward. We're happy to give our answers. Maybe they'll help you inform what's the right thing to do. But remember, you've got to own your own answers. You've got to come up with the right answers for you and your situation. You can do it. I believe in you. All right, Jeff, we'll see you next time.
See you next time.